Hello, Internet. My name is Ryan Ingram, and this is the 8th episode of the Millionaire by 30 series. And for the past 2 episodes, we've been talking about investing. And this episode, we're going to talk about investing in businesses. In this episode, when we talk about investing, we're talking about either looking at purchasing a business or actually starting a business. Businesses are a lot like your personal finances in the fact that they have income and expenses. All right, now this income for business purposes is often called your gross revenue. And in your business, once you get money, then this is not yet taxed. In your personal finances, especially if you're a W-2 employee, the money that you receive has already been taxed. Income, your gross revenue, those are all pre-tax dollars. So from your pre-tax dollars, you take out all of your expenses. We've all heard the term business write-offs, and that's what this is. It's writing off or reducing your gross revenue from all the expenses. And in your expenses, you have things like, payroll, office space, equipment, anything that you need in order to run your business. All of that can be used to lower your gross revenue, but nonetheless, this is a really important number. Now, your income minus your expenses is called your net revenue. Now, this number is kind of important, but not so much. So if we were to use this same kind of imagery that we've been using with these buckets, then your business, you have your income, and this comes from you providing some sort of value or service to your consumer, to your customer. And when that money enters, all of your expenses still leak out. There are things that you have to pay: payroll, rent or mortgage, equipment, everything it is that you need to run your business. Now, any money that stays in here is your net revenue, not your profit, but just the net revenue. Now, this is where businesses get really powerful to building your net worth or helping you reach this millionaire by 30 mark. All right, so if you remember when we were talking about the others, the stocks and the real estate investing, we said that $1 equals $1, right? For stocks, if you $1 that you put into the stock market will buy you $1 of stocks. And at this point, you're either waiting to get your dividends or you're waiting for the value of the stock to rise. Now, of course, time plays a factor, kind of like we discussed in the wealth formula video. So you are able to assume, using historical averages, that if you leave your money in the stock market for 20, 30 years, you could expect this to grow exponentially. In real estate investing, you have the ability to use sweat equity, so that you could use $1 to buy a derelict property, fix it up, and you could have, I think a conservative guess would be about $4. Now in businesses, your $1 that you put in, each industry has its own multiplier or valuation that they use in order to figure out how much the business is worth. So this becomes really powerful because the business's income most certainly comes into this bucket and all of the expenses go out. However, there's a valuation on the back end that kind of creates another bucket. So just because you have a business and you're bringing in revenue, chances are if you ever wanted to, you could sell that business. And the formula for selling that business, there's 2 of them. You can use a gross revenue multiplier, which it doesn't take into consideration your expenses or the net revenue. It's just however much you make in the business times a certain number. Since I own an insurance agency, let's talk about that. So for the net revenue, I know that my industry, the gross revenue multiplier, is generally 2.5. So for this income stream, each dollar that I bring in puts $2.5 into the bucket. And this bucket has no holes. This just immediately adds to your net worth. So for example, let's say that an insurance agency makes $100,000 per year. That has no consideration of any sort of expenses, payroll, or any of that. That's just the gross revenue. You can multiply that by 2.5, and that is what the insurance's book of business is worth, or $250,000. As I went from a W-2 employee to an entrepreneur, this is one of the largest things that had an impact on me. So let's say you had a job where you made $100,000. You couldn't sell your job to someone else for $250,000. So long as you worked at this job, the $100,000 paid all of your monthly expenses. But since this income is a business, the business can be sold. So while you own and operate the business, you can bring in your $100,000 per year. Now, granted, you're going to have to pay all of your expenses, so what you're left with could be substantially left, but any of that money can go into your personal pocket. All the while, you have a valuation of $250,000 that's adding to your net worth. So it's almost like double dipping, because unlike in your personal finances where you have to actually retain money in your bucket in order for it to add to your net worth, the business, you can use all of the money that's coming in and you can keep this valuation added to your net worth. So this is more of an archaic form of valuating businesses. Let's talk about the way that a lot of industries are kind of moving towards. Industries are moving towards valuations based on what's called EBITDA. It's earnings before interest, taxes, depreciation, and amortization. That's EBITDA, EBITDA. Earnings before income, taxes, depreciation, and amortization. So your net revenue, not all of these expenses count against you. So let's say you own real estate and that is depreciated on your tax return every year, then the EBITDA would add back in the depreciation. Whatever your taxes were on the business, those would be added back in. The interest, any interest that you pay, also added back in because it's the earnings before these items. So it's similar to the gross revenue in that it has a multiple, but these multiples, similar to the gross revenue, that 2.5, it varies by industry. So let's look at an example of those. If the business makes between $0 and $1 million, then in the manufacturing, your EBITDA would be 4 times. So if you had an EBITDA of $100,000, then that business is worth $400,000. If you had an IT company and you did between $0 and $1 million, then your IT company, if you had an EBITDA of $100,000, then your business would be worth $650,000. Okay, so if I were to have to start over and do everything again in order to hit the Millionaire by 30 status, then I would look at these businesses. Now, while I had a job and while I was focusing on being extraordinarily frugal, I would also look at industry EBITDAs and I would try to start a business based around these numbers. So here, if we were looking at this sheet, then you see IT, if it does less than $1 million, it's 6.5. If it does 2 to 5 million, it's 8. And same with the 6 million to 10 million. Now, what I would want to do is do everything that I could to get my business's revenue as close to these numbers as possible. And as soon as I hit 2 million, I would be looking to sell. And at that point, you can sell the business whenever you feel comfortable pushing the eject button. This, primarily, the business aspect, is how a lot of very young people have immediately become extraordinarily wealthy. All businesses come with their own list of pros and cons. Starting an IT company might not resonate with you at all, but take a look through those lists, find what would be most worth your time, and get to it. So the way I like to start businesses is I like to start them on the side in my free time as I still have active income coming in. And as the business grows, as the demand grows and starts taking up more of my time, then I slowly transition between that and my full-time job. And then once this business becomes full-time, then I give it as much energy and attention as necessary until I get both the valuation where I would like for it to and the income that it provides me. And this is how you can dramatically increase your net worth in a very small amount of time, because not only is the business providing you income to live on, it's also building value, building equity, and adding to your net worth, which is an extraordinarily powerful process that can help you reach your goals absolutely as fast as you can possibly scale your business. Thanks so much for watching. This is a lot of content that we shoved into a really short video. So if you have any questions, if you have any comments or want any additional clarification, please let me know. I would be happy to talk about as much of this as possible so that you can understand everything fully and reach your goals as fast as possible. So thanks so much for watching. Tomorrow we're going to be talking about peer-to-peer lending, which is a great way to make above average returns on your money. Thanks so much. Talk to you guys soon.